Please come over to the stage.
So once again, good morning and welcome to all of you. Let's get started the day with something which is very close to the heart of, it's a passion for many of us, which is to do with mutual funds. So one of the things which amazes me, I've been involved in capital markets, financial markets for over 3 decades, is that how there's a big dichotomy. It's taught in textbooks. The theory says that, the game is long term. But in practice, everyone looks at short term. Okay, and this is true for this market as well. When, till last year, India was the flavor of the month, and this year, perhaps the enthusiasm has dwindled. Okay, what do we, first of all, tell this audience about why do they need to have a long-term view on India and why India deserves the place? So let me start that first with Neil.
Thank you, Prem, first of all, for having me here. It's a pleasure meeting everyone before the meeting. So I think one thing is that I think since last 5-7 years, the markets had a really good run, people have made a lot of money. And markets are supposed to be volatile. They just don't go one way. So, in fact, I'm actually quite happy that we've taken a bit of a breather, a pause, because as value investors, you want a better price to buy, So one of the things is that the only way and the best way to make money in the market is buying low and selling high, So obviously, valuations were a bit stretched, and those are coming to a reasonable level now. So in a way, I'm not too sad that the markets have taken a breather, and it actually gives us a good opportunity to enter.
Okay. But what do you have to tell this audience? From your perspective, you say this is a great market, you're going to pick up some good value, which is going to reflect in your performance today. But give them a reason to come into India now.
Oh, okay. So a lot of reasons to come to India. And a lot of them have been articulated over time in the media and stuff like that. First of all, we have a young population. I mean, consumption is only going to increase, with the digital infrastructure that's available, UPI and Aadhaar-based stuff, So digital onboarding is easy. Young population will consume more. I think also the fact that I think we've got the deepest stock markets in the world. We have more than 7,000 listed stocks. We have so many more IPOs coming. A well diversified companies or sectors. So it's not like we are in some countries. If you're strong in a commodity play, 80 or 90% of the market is only that. But here we have all kinds of sectors, all kinds of industries where everyone can participate. So I think I'm extremely bullish for the next decade and more. I think one thing is that don't see it in 6 months, 1 year. Me and Vishal were just talking about it right before we entered that, the problem is people looking at very short-term performances or looking very short-term ahead. But I think if you look at it and you think of it in decades, I think there's tons of opportunities in India, and don't miss it, please.
Okay. Madhu, why should they look at it from a long-term perspective and not as a tactical bet?
So all this while, we have been seeing India as a tactical play, trying to basically time the market, trying to play on the speculative side of nature we all have. But if you see the recent trends, a few of which Neil has already narrated, but one thing is we are lower in terms of volatility compared to other emerging economies. Secondly, we are in the fastest growing economy. The world is slowing. I think India is the only country which is growing by leaps and bounds. Third, most importantly, if you see the China story, when they crossed $3,000 of per capita income, and India is just shy away of that. We have already crossed $2,400 of per capita income. So the kind of growth we saw in China is what is being reflected in Indian economy today. And also the sheer fact that we are the youngest population in the world. And as United Nations study says, we will continue to be the youngest country till 2055. And lastly, the kind of structural reforms which our country has gone through, be it taking care of that parallel economy or the black economy, which is seen in the corporate results, which is also seen in the deleveraging of balance sheet thanks to post-COVID era. India is the best place. India should be the should be the core portfolio in your asset allocation today. And then you can build a satellite portfolio around that.
Okay. Vishal, I have the same question for you, which is why should India be looked upon as a long-term story and not as a tactical bet only?
Thanks, Prem, and thanks again for inviting us all over here. So I think some of the longer-term structural reasons to be in India, Neil mentioned about it, Madhu mentioned about it, and I think all of us in the audience will largely have read, reams and reams of data around that. So look, demography plus governance and government initiatives, consumption, all of these are very long-term themes. And as an investor, long-term investor, I think it's then becomes a question of when and how much, in a sense. Now, I was privileged to be as part of the panelists last year as well, and I come and met some of you last year as well. And at that point in time, the question that was foremost on most people's mind was, yes, we get the India story, but aren't we a bit worried about, number one, valuations? Because recently there's been so much of a run, and at this stage, valuations look a bit stretched. And number two, there is general forecast that earnings will slow down a bit, and therefore we're not so sure. Number three, growth is happening only in pockets. There are some parts of the economy, especially consumption, where we're not seeing enough movement. So large part of the growth has come through capex investment that the government has made, and that cannot continue forever. So at some point in time, private sector has to pick up the pace, and these are some of the concerns in mind. Now let's look at today, right? So 1 year later, what's happened? Number one, markets have been largely flat. Depends on which part of the market you are in. So in some sense, the time correction has already happened. So therefore, of course, valuations today look far better than they were looking 1 year back. Number two, a significant amount of government reforms around boosting consumption has happened. Firstly, and the two large ones I would call out is one in the form of increasing the tax exemption limit, which actually impacts a very large part of the tax-paying individual population, right? So more hands in the hands of the consumer, which means a lot more boost to consumption. And more recently, really slashing down GST rates. GST rates coming down, boost to consumption, and the festive season recently that anyone saw in India was probably the best in our memory in terms of how much consumption happened. And therefore, suddenly, everyone's expecting a big boost in earnings next year onwards. And yet, we have the market at the current level. So I would ask the audience and anyone thinking about India longer term, why would you not, is the question. If you were always bullish on the long-term government story in India, isn't today probably one of the best windows you're getting, where the market may not have as yet picked up the buoyancy that I think is very evident. To us, it's a matter of time before the earnings pick that up, because that's something we see on the ground. The second thing I'd want us to think about is the allocation. So a lot of people tell me that, look, yes, I have an India allocation, and I say, how much? And it's typically very low single digits. And 2, 3, 4% saying I'm a global investor, and that's about it. Let's recognize the weight of India in the MSCI has moved up significantly, from just a few decades back when we were used to a 2, 3, 4%. So today, I do think just the allocation also needs to be refreshed. And whether it's you yourself or your customers, definitely I would think at the minimum, you have to reflect the size of the economy that India now represents in your customer's portfolio, just to be neutral. And two, if you're getting a market which has got visible signs of growth well above most competing markets at a reasonable valuation, not cheap, but not rich either, why would you not go overweight, would be the question I would ask everyone.
Okay. Jignesh, I have a slightly different question for you. If India is the market to be in, and if India deserves an allocation, Why should it be done through mutual funds and not through direct stocks?
So first of all, thanks Prem for inviting me and for my company's compliance 10.1 disclaimer that I am here only for sharing my views and my intent is not to sell any product or services. So yeah, I think if you look at the private sector got approval to conduct their business in India in 1992. And I think even today, the Indian mutual fund regulation is one of the best regulation in the world. One. Second is, if you look at any 10-year, 20-year, 30-year data in each of the category, whether it is a small cap, mid cap, flexi cap, large cap, I think the average alpha generation in each of the category at an average level is around 2 to 3% over any 10-year period, like 10, 20, and 30 year. So I think it's one of the fantastic market in the world. Number one. Number two is, unfortunately, if you see in 2000, the market was at 1 lakh crore. And when we started in 94. I think that at that time the market, you were also there with Khatri and all, the market was less than 1,000 crores. But I think the good reference point is in 2000 market, the entire market was 1 lakh crore. Today it is 75 lakh crore. But unfortunately, we have only 5 crore 40 lakhs investors. So there is a huge opportunity even for Indians. NRI is always there, but I think it's a great opportunity to participate in Indian mutual funds. Second is, if you look at in terms of cost, I think we are the cheapest in the world. The kind of alpha the fund managers generating over a period of time, and against that the cost is minuscule. It is around 1.5–2%. So I think it's a great product.
Okay.
You get a gold at silver price.
Okay. So you're saying mutual funds are performing well, the fund managers are doing a good job, and they're doing it at a very low cost. Okay.
Great regulator, cheapest cost, excellent performance, no-brainer.
Okay, no-brainer. Neil, how about, what do you have to say on this? Why should they look at mutual funds as the route to enter India and not direct stocks?
Yeah, so adding to what Jignesh bhai said, one other thing is that the onboarding has become very easy now. Digital onboarding is possible, and yeah, there are sometimes some operational issues here and there, but generally we've come a long way in onboarding and having a very simple stack structure, for investing in mutual fund compared to say a PMS or a direct stocks, where operational efficiency is much better in a mutual fund. And going forward, I think this can even get better because I think a lot of people are also setting up shop in GIFT City. So what happens is that you will get the allocation to the local mutual funds, to the GIFT City route. And here, a couple of the things that were an impediment as such, for NRIs to invest there was having a PAN card, converting your dollars into rupees and investing there. And also, you don't need to file taxes also in India. So this route has started. Also, it started with the retail funds. So back in 6 months back or a year back, the minimum investment used to be 75,000 to $150,000, which has come down to as low as $5,000 and $10,000. So accessibility has improved. Yes, there are on-ground, I was talking to a few people outside, and the on-ground reality is that theoretically this is an amazing thing, but obviously there are some banking challenges which I feel will get ironed out in the next year or so. So I think after a year or so, this GIFT City offerings would become quite popular in my view for NRIs to invest.
Okay. Madhu, are you looking at a GIFT City option? Have you filed for one? And what would you tell the audience as the founder of India's latest, most vibrant mutual fund house? What do you have to say to this audience about investing in India through mutual funds and not direct stocks?
So you have many options like mutual fund. You can do direct stocks, you can do PMS, and you can do AIF.
Yeah.
But let me tell you, the most favorite topic of Dubai investors is taxation.
Okay.
So mutual fund is the best product which gives, I think, zero taxation. We have a DTA here. And secondly, the seamlessness, the ease of entering into mutual fund transactions is much, much higher. It gives you so much liquidity compared to other products. Third, you have an expert. Jignesh bhai spoke about kitne saste mein aapko expert fund manager mil raha hai to manage the portfolio, right? So this cannot be better than that you have an expert fund manager managing the portfolio day in, day out for you, because see, you are sitting out of here and we all get perturbed by the kind of negative news, right? Or which may or may not impact, but because you are looking it from here, you may get scared as well. Also, is the amount at which you can enter. AIF has a large amount. PMS also has a decent 50 lakhs ticket size. In mutual fund, Neil has a retail platform. So with a smaller amount, you can take benefit of this. And lastly, mutual fund offers the diversification, which direct stocks mean you have to be completely involved, devote a lot of time, and you have to be best at managing the stocks, right? Which is definitely not possible. So I would say the best way, and the only way rather, to go for investing is through mutual funds.
Okay. So, Vishal, what percentage of an NRI's portfolio should be allocated to Indian mutual funds? What if your best friend who's now working in Dubai were to ask your advice on constructing a portfolio, what would be your recommendation? Not wearing the hat of a manufacturer.
Right. No, I think, see, naturally, as you would expect, we are all India bulls, right? So, expect that we will tell you that you should be overweight. Right? We spoke about why we think you should be overweight. Another way to look at it is that as an overseas investor, not just an NRI, let's say a global investor, and I think most NRIs I speak to see themselves as a global investor. So yes, of course, there is an India leg, but for money, you want to maximize the overall return for the risk that you're taking. I would just pose a few of the, really the basic questions. Over the next decade, where do you see growth being higher? The West, the Central, or the East? Which countries do you think will deliver the highest growth? And if we don't know, go to an independent source, go to the big economists, the multilateral organizations, the broking house, and see who's predicting which country to grow. Now, fundamentally, if most global players, don't listen to just us, we are biased, I'm telling you that, are going to forecast that real economic growth for India is going to be far superior to most other investable economies. Investable meaning regulated, enough choice, access vehicles, taxation, governance, currency stability, etc. I would question that, isn't it time to really take a deep relook at your overall allocation? Now, to me, the minimum you have to look at is the weight of India in the indices that you track. So, in an allocation, you will largely have some index or some, basket that you track. For many over here that I speak to, there is a US allocation. I would say take a look again because the market has done very well. So even if you were to just do a simple rebalancing, that will throw up some amount of opportunity for reallocating capital. Then you've got an emerging market basket, and look at India's weight over there, and you will see that that's been growing and expected to grow even faster there. Even a simple reallocation would put that very close to a double-digit allocation. And at least the portfolios I've seen seem to be, like I mentioned earlier, very small single digits. So clearly a 3, 4x, 5x opportunity from investors are today. And I would say that it is a long-term opportunity. The signs are all there for us to read. Don't wait forever before the market then becomes where we were last year, which is, oh, it's run up so much, and is it not now richly valued?
Okay. Jignesh, Vishal seems to be suggesting that it should be definitely in line with the global allocation of a broad-based index such as MSCI. What is your take on this, given the fact that these indices are not so heavily, I mean, India doesn't feature so prominently, and certainly features very prominently in their hearts. So what should they do as far as the Indian allocation is concerned?
Yeah. So for, I think for NRI, I don't suggest leverage, so probably 100% towards India.
Okay.
And for global investor, what Vishal said is correct. I think one should look at their overall MSCI allocation and probably then figure it out. But I think the most important thing, whether it is NRI or foreign investors, one should look at the history. We have now 32 years of history on mutual funds. And if you look at in each of the parameters, we are 10 out of 10. Then why not Indian mutual funds?
Okay.
The only difference between NRI and foreign investor is NRI, he understands the country well.
Yeah.
So that's the added advantage.
Has
And there
more
has always
confidence.
been, if you look at globally also, there is a home bias. So irrespective of the performance and all, I think home bias is always there. So we expect from NRI also to have their home bias.
Okay. Okay, Neil, I'll start with you on a slightly different note on what should be the core part of their Indian portfolio, okay, and what should be the satellite part of it. What product, which is the first product they should start with if they're looking at Indian allocation?
Yeah. So I personally like to keep it pretty simple and not have too many funds, to confuse as such. So in my view, and what I have seen, and not only for an NRI, I think it's for pretty much all investors, is that having a diversified approach or 2 or 3 diversified schemes, and on the large cap space, you can play the passive, So one passive large cap and 2 or 3 diversified funds is, I think, good enough allocation. I don't think, I'm not a guy to have core and satellite part. I feel in a diversified mutual fund, if there is a sector or a theme that you do like, the fund manager is free to go between sectors, between market cap, between even geographies, So keeping it simple is what I feel has worked for me and worked for a lot of the investors that I have met, and having about 3 or 4 funds should be good enough and keep it diversified and passive.
Okay. So the fund manager will take care of any opportunities which are thrown up by any particular theme. He will include them in his portfolio. There's no need to look at it separately.
Absolutely. I think people should concentrate on their primary work, whatever they have, and investment, let it be with the fund managers. Like Jignesh Bhai said that we've had 30 years of great track record. So.
Okay. So Madhu, would you agree with that? Would you want there to be a lot of choices, and should NRIs have something for the core, something for the satellite? They should have something for theme. How should they play it? What is your advice to them?
I completely echo what Neil just said. In investment parlance, it's our hard-earned money. We need to keep it very, very simple. And I get it that newness and that adventure, which is here, between both years all the time, you can play it out in buying watches or luxury cars and so on and so forth, or houses, but not in terms of investment. And also, you need to make a core portfolio. And when I say core portfolio, we believe it has to be lesser volatile. So probably a multi-asset would play multi-asset, which is a hybrid one, would play a better role, because traditionally the volatility in case of hybrid multi-asset is half of an equity fund. And then you can have, satellite-wise, you can have a flexi cap, or you can have, as Neil spoke about, index-driven large caps. So those should be your, 3-4 funds is what you maximum needs. And if you see the history which Jignesh Bhai spoke about, 30 years, 20 years, all these funds have delivered very good returns. Consistent compounding is what you have seen. You really don't need thematics. You don't need other, sectoral funds. And we have seen sectoral funds, they do well for 3-4 years, and then comes a downturn. Right? And the nature of the sectoral funds, because these are sectoral funds, each sector plays out probably 2-3 years. And so difficult for an investor to follow that sector and do the rebalancing. Right? So that's where these 3-4 allocations are good enough for an investor's portfolio.
Okay. Vishal, what is your take on this? Both Neil and Madhu feel that you should have 3 or 4 broad products which will cover enough. Madhu added something like multi-asset also in that particular portfolio, but her take was largely in line with what Neil said. So would you believe that the opportunities there in India are too myriad, and you need to have a broader spectrum of funds in your portfolio, or should you keep it simple, just 3 or 4 core products and go with it?
No, I think I would agree that there is real benefit in keeping it very simple. But I just try to look at what are we trying to achieve? What is the simplicity trying to achieve? At some level, if I would think you are a first-time investor into India and you don't want a lot of excitement with your money, then a large and mid-cap oriented strategy should do the job very, very well. Right? So just one product should be good enough, in a sense, because the idea is just try and beat the broader market, etc. Having said that, if you know a bit more about India, you're okay with a bit more volatility, potentially, one would argue that a lot of growth in India is actually happening in the small and micro cap. I think earlier we spoke about a lot of IPOs, on the way. Keep in mind, in an economy which is transforming, where a lot of private equity money has been actually seeding and growing businesses over the last almost decade. Yeah. At one estimate it was like $180 billion. And that will now eventually come as supply into the public market space. That presents long-only managers with a great opportunity. You can choose the price you want to enter into, but the supply is actually coming in at that part of the market and makes it very rich, very interesting. So I would say don't ignore the small cap space, because that's where a lot of alpha generation, a lot of economic progress is happening. These are new industries, innovative business models, which otherwise you would not have access to. Yeah. And the third, slightly contra view I would also put on the table is don't completely ignore Indian government securities and a play on the rupee. Keep in mind, of course, most investors have most of their assets in dollars. And given just the macro situation between the largest economy and an emerging economy like India, would it be fair to say that an India government security is something you should ignore? And I'm saying ignore because most people don't have that as an asset class at all. Now, keep in mind, yes, the nominal rate on the GSEC may not look very attractive versus maybe the US, but you have to look at real returns. So nominal minus inflation is what you have to look at. And one would argue that real returns on the Indian Gavi is still quite reasonable. And the notion that, every year the rupee depreciates by 4 or 5% is something you have to relook at. So what if that doesn't happen? Now, it's a very different subject, but I would say keep an eye out for rupee assets as well through government securities or corporate bonds or high-quality corporate bonds, because that could be another asset class that is generally not spoken about.
Yeah. So, Jignesh, your take, he's suggesting, and so far we've been focusing completely on equities, even in our discussion, but should they be looking at other asset classes through mutual funds, such as government bonds, corporate bonds? Should they be looking at such funds also in, outside equities?
Yeah, difficult question for me, because I only understand equity.
Okay.
And I think, it's all depends upon your risk appetite.
Okay.
And based on the risk appetite, probably you can create your asset allocation plan. And government security, bank fixed deposits are the good options for allocating your money towards debt and all. But I think for India, I would say by not taking risk, it is going to be the big risk.
Okay.
Because we have a long runway ahead. And in terms of selecting products within equity mutual fund, I think we should not waste our time there.
Okay.
But I think the biggest challenge why people are unable to make money is they are not giving enough time to their investments. If you look at the fact sheet of any of the mutual fund of last 10, 20, 30 years, they have generated good returns. But if you look at the fact sheet of Indian investors, I think they are not able to generate return on their portfolio.
Okay.
Is because of the time. And I was crunching couple of data points. I think the new investment which are coming into mutual funds, I think more than 50 to 60% they redeem less than 1 year. And very few minuscule percentage of investors are there for more than 5 years. So I think globally also, and India in particular, the power of compounding is undermined, because even the fund generate 12% return, and if you stay invested for let's say 10 years, your money is 3 times. But if you stay invested for 20 years, your money is 9 times. So there is no fun in 10 or 20 years. But if you stay invested for 30 years, it is 30 times. So in each of the period, if you look at your return on investment is 12%. But if you invest 1 million, then in 10 years it is 3, but in 30 years it is 30 million with the same return on investment. So I think that power of compounding is a very, very powerful idea to really create a serious wealth. And I think India is a compounding machine. It's the right place to come and invest and take a long view. I think short term, there is no fun in India. So if you want to make a serious wealth over a longer period of time, I think India is the right place to be in.
Okay. While we will have a separate session on Gift City today, I wanted this panel to look at what are the tax considerations, what are the regulatory considerations while investing in Indian mutual funds. I'll start with you, Neil. Keep it simple.
Yeah.
Tell them what to do and what are the things that they should look out for.
Right. Okay. So if you're investing in a mutual fund, in an Indian mutual fund, one thing is that you need to have a PAN card. You will need to have a bank account, either NRI, NRO account, and NRI accounts, there's no limit to repatriate back to the country. NRO account, there are limits to how much you can take, you can repatriate back to your home country. Tax filings will have to be done in India in terms of what a resident Indian will do in terms of long-term and short-term capital gains tax. Yeah, these are 3 main things.
Okay. And what advantage would a Gift City domiciled fund offer over something which is not on Gift City, where you could invest directly in a manner of speaking?
Sure. So if it's feeding into, from a Gift City fund, feeding into a local mutual fund, then all the above get actually, all those problems go away in terms of having a PAN card. You don't need a PAN card as such to invest here. Currency risk is real in terms of if you're investing from outside the country, you need to, in a mutual fund, you need to convert into rupees and invest. In a Gift City route, you can invest your dollars directly there, and there's no tax filing in India.
Okay. Madhu, have you looked at this particular aspect? What do you have to tell them about the tax and the regulatory aspects of investing in India?
Gift City is actually a boon for NRIs and GCC region investors. And Neil has already mentioned everything. It's the best tool, lot of transparency. It takes away a lot of your paperwork and with the retail kind of structure, like PPFAS has, so the ticket size also comes down. So we are going via the AIF route in GIFT City.
Okay. So are you looking at something in GIFT City? Have you, do you already have funds domiciled in GIFT City?
Yeah, we do. So like I think Neil and Madhu mentioned, clearly it seems that while NRIs did have the opportunity of investing directly into mutual funds in India, I liken it to a city road in Mumbai or any large city. Lots of choices, but you can feel a bit overwhelmed, coming in as an NRI. But now there's an expressway, which is through GIFT City. So why not be in familiar territory? It just takes care of all the issues. It gets you there, but gets you much faster, much more efficiently. Something you're more used to as well, because you don't have, like Neil mentioned, no PAN card, no bank account, tax filing requirements, all of that. So why not take advantage? Initially, like with any expressway, you may find that you don't have all the flavors of the little streets, because there will be only few funds available. The entire 1,700 funds will not be accessible through GIFT City. But I think many fund houses, including us, have made a specific choice to say, look, these 2 or 3 funds may represent largely what you're looking to do. So, for example, we've opened a branch where we're offering, one large and mid-cap strategy as a feeder, one small-cap strategy as a feeder, and one GSEC strategy as a feeder. So, both asset classes in the full width can be covered just from 2 or 3 funds. So, sometimes just keeping it simple, that may be an efficient way to access.
Okay. Jignesh, starting with you, we will have a final round on one piece of advice that you would give to NRIs wanting to build up a India portfolio through mutual funds. What is the one piece of advice that you would give?
Yeah, welcome to India and invest your money with Indian mutual fund and stay for long term. I think you will have a very pleasant experience.
I think your point about compounding was very, very relevant. One of the things that people, Jignesh made a very powerful point, and I'd like to repeat that. There is often a difference between what the fund delivers and what the investor earns, because the investor behavior is different from what the fund has done. So if you come in, go out, exit at the wrong points, you end up making suboptimal choices. You end up depriving yourself of the opportunities which the fund offers. You deprive yourself of wealth creation opportunities. So once you've taken a decision to invest, stay invested, stay the course, leverage the power of compounding, and let it accumulate wealth for you over the long term. So I think that's a very powerful point that you made. Neil?
Yeah, so kind of similar points like his is in terms of like, look at it in decades. Don't ignore India and look at it in decades, because over decades, we've seen that Indian fund managers have really outperformed. Their risk, reducing risk strategies are also there. So it's not like people are taking excessive risk to do that. So the risk adjusted returns are great. Fund managers now have a big track record also, so people can look at what they've done over in their history. And I think the future is bright for India. Don't ignore it. And I think if you have a 1 decade or a 2 decade kind of view going forward, I think there's tons of money to be made in India. So don't ignore it.
Okay, Madhu, what is your final piece of advice to this audience?
Being from India, all I can say, the time to invest in India is now.
Okay.
Don't miss it. It is the best tool for your wealth creation.
Okay. Vishal, what do you?
I think just want to echo everything that has been said. Sometimes I think that we, when I look at where are investors getting stuck, and, so people understand the long-term macro opportunity, but I think in trying to do too much, and being almost too active or too smart, we end up making mistakes, and then the experience is not as good.
Okay.
But often sticking to the basics that I think Jignesh Bhai spoke about, Neil and Madhu spoke about, which is if you're taking a long-term view, you're keeping it very simple. I think it's very unlikely that you will get it wrong. And now that very efficient structures are available, if you're not to take advantage of it now, I would really question, what are you waiting for?
Okay. So with that, we've come to the end of our discussion. And thank you for sharing your insights. Such wonderful points which came out. And I'd just like to sum up some of the things. India definitely deserves a big allocation to in your portfolio. Number two, don't look at tactical calls. Make it simple. Invest long term. Fill it, shut it, forget it would be the kind of model to follow, because that is what really creates the wealth opportunities. As far as the number of funds and where to invest is concerned, definitely the group felt that you should keep it simple, have 3 or 4 core products. Vishal added that perhaps you could also look at government treasury. You could look at corporate bonds as well. But the consensus was that don't try and bet which sector is going to do well and hence put your money there. Let the fund manager take that particular call. And finally, leverage the power of compounding and let it work for you over the long term. So thank you so much.
Thank you.
Thank you. Jignesh? Good. Madhu? Well, thank you, Madhu. Thank you for coming. Come, let's have a group. Ramesh, come, join us.